Welcome to this explainer. Imagine, for a second, trying to take a massive, dense, textbook-sized compliance manual and morphing it into a lightning-fast, totally invisible defense system. Well, today, that's exactly what we're breaking down. We're looking at how to construct an absolutely ironclad defense perimeter for a revolutionary physical-to-digital financial network. Basically, we are talking about taking the messy cash economy and bridging it to the digital world, safely and at a massive scale. Here is our tactical blueprint for the session. We'll set up the defense perimeter, map out the actors and service flows, look under the hood at the operating engine, run through the mandatory pilot checklist, and then see how this framework actually becomes the infrastructure. All right, kicking things off with Section 1, the defense perimeter. Because let's face it, you just can't scale a global financial network without a rock-solid foundation. So let's talk about the Safe Harbor Protocol. Think of it as a master blueprint for building an impenetrable regulatory shield around a branch-light pilot project. It guarantees full anti-money laundering compliance, liquidity resilience, and systemic security. But here's the real kicker. It does all this without slowing down the actual speed of commerce. We're talking about embedding hardcore compliance directly into the real-time flow of physical transactions. We want the security of a fortress, but with the speed of a slick tech platform. To actually pull this off, you need a highly coordinated cast of characters. You've got the regulator and chief compliance officer calling the shots at the top, cascading down to the merchant network, acting as the crucial first line of defense. And then, of course, the customer. But the real heavy lifting? That happens right in the middle, with the automated compliance and risk management engines. These systems are constantly running in the background, hunting for cash concentrations, geographic weirdness, and transaction velocity anomalies across the entire grid. It's human oversight supercharged by machine precision. Moving right along to Section 2, actors and service flows. Let's see how these parts actually move together in the wild during real transactions. Take a look at this flow. It's a brilliant example of modern compliance during an assisted checkout. First, your mobile app handles pre-verification using biometrics before you even step up to the counter. Almost instantly, the system scopes the risk, checking your requested deposit against your historical habits. Then, it confirms the merchant's compliance health and finally fires off an encrypted zero-knowledge payload. It's wild. A massive amount of fraud prevention logic happens seamlessly before a single dollar bill ever changes hands. But what happens when things look a little shady? Say someone starts feeding a bizarrely high volume of small bills into a self-service kiosk. Boom, the anomaly engine triggers. A silent alert instantly pops up on the retail manager screen in the blink of an eye. The manager casually walks over, assesses the scene, and if the suspicion holds up, the system automatically drafts a suspicious activity report right for the compliance team. It's a lightning-fast escalation that perfectly marries automated detection with real human judgment. All right, Section 3, the operating engine. Let's dive into how we push all this heavy compliance stuff entirely into the background without ruining the user experience. Let's be brutally honest. Nobody wants to be interrogated by a cashier over a $50 deposit while a massive line of impatient people stares daggers at them. That clunky traditional method, it's completely done. Instead, we use a clean, totally invisible mobile interface that privately guides the user. By bearing those clunky compliance steps in the background, we neutralize the risk without the public spectacle. The golden rule we follow here is simple. Friction should only increase when risk increases. And right behind that slick interface is a seriously rock-solid financial foundation. Every single deposit is backed by pre-funded clearing collateral, held securely in escrow. This is huge. It means there is a strict, total separation between customer funds and operational accounts, completely wiping out partner credit risk. Even if a retail partner goes under out of nowhere, the user's funds are fully protected and perfectly settled, no exceptions. To keep this whole machine running smoothly, different operational domains have to act like a perfectly synchronized pit crew. The point-of-sale platform handles identity integration and localized data wiping to keep privacy locked down tight. Meanwhile, cash management is scanning for counterfeits on the fly. Operations handles real-time audits and training, while customer comms is pushing out instant, transparent receipts. Every single piece of this puzzle is critical to keeping the engine humming safely. Now we have to talk about bottlenecks, because honestly, the most secure system in the world is totally useless if it completely freezes commerce. Keeping our false positive compliance rate strictly below 4% is an absolute tactical necessity. If we start flagging too many innocent transactions, we create a disastrous traffic jam at the checkout counter. We need over 96% of valid transactions flowing seamlessly just to maintain the everyday speed of business. But while we tolerate a tiny margin of error for false positives to keep those lines moving, there is one area where we demand absolute zero-compromise perfection: audit match accuracy. This target must hit exactly 100%. We require a flawless, penny-for-penny match between the physical cash audits at the bank and the electronic logs on our network. Every single cent must be accounted for, leaving a totally immutable audit trail. Which brings us to Section 4, the pilot checklist. Before this amazing operating engine ever sees the real world, we've got some uncompromising boxes to check. Consider this our launch sequence. It sounds intense because it is. We're talking strict licensing validations across the board, tiered KYC and AML monitoring, and mapping out agent risk with dynamic geoscoring. We have to tightly manage liquidity risk using automated float rebalancing triggers, and then wrap the whole thing up in hardcore consumer protection and end-to-end encryption. Once every single one of those boxes is ticked, then and only then are we cleared for launch. Finally, we reach Section 5, becoming the infrastructure. The perimeter is built, the compliance is invisible, the checks are done. Now it's time to scale. Once you actually perfect this zero-knowledge infrastructure, you really have to ask yourself a big question. What happens when this pilot network scales up? What happens when we unleash this exact capability into unbanked jurisdictions, into markets where traditional banks never even tried to reach? I'll leave you with this phenomenal thought straight from the source material. This is not just about depositing cash. It is about turning every street corner into a bank, every merchant into a node, every transaction into a bridge between the physical and digital economy. And in markets where banks never reached, this network does not follow infrastructure. It becomes the infrastructure. Just think about the sheer magnitude of that for a second. If we successfully turn every local corner shop into a secure, fully compliant on-ramp to the global digital economy, who actually holds the power in the future of finance? Thanks for joining me on this explainer. Keep questioning the systems around you, and I'll catch you next time.